Not owning real estate might be the best thing to have ever happened to you. I'm David. I own FilterBuy, an air filter manufacturer that does $23 million a month. Before that, I worked on Wall Street as a VP at Goldman Sachs. I've studied real estate for years. I've run the numbers over and over, and every single time I walk away thinking the same thing. The game has changed, and almost nobody is telling you. So, in this video, I'm going to show you exactly what I'm doing with my money instead. Real estate didn't build wealth because it was a genius investment. It built wealth because of a 40-year accident that most people never noticed. Real estate didn't make people rich. Something much more boring did. Here's a chart I want you to picture. From the early 1980s all the way to 2022, interest rates in the US went basically one direction. In 1981, the 30-year mortgage rate was around 18%. By 2021, it was around 3%. Now here's why that matters. When interest rates fall, real estate prices go up. It's almost mechanical. Lower rates mean lower monthly payments, which means buyers can afford to pay more for the same house. More buyers chasing the same houses, prices go up. This happened slowly but consistently for 4 decades straight. So the people who bought houses in the 80s and 90s, they didn't just benefit from appreciation, they kept refinancing into lower and lower rates. More cash in the present and more equity value in their homes. That's the whole playbook, and it worked incredibly well. Not because real estate is magic, but because interest rates had one of the longest one-way runs in financial history. Here's the problem. That run is over. In the pandemic, we dropped interest rates to 0. We hit the bottom and we'll have to raise rates before we can take them back down again. So the same tailwind that quietly made millions of people rich over the last 40 years, it's gone. And most of the books, podcasts, and YouTube videos teaching you to buy real estate were written when that tailwind was in full force. Think about what this means for someone buying their first rental property today. You're not just buying a house, you're making a bet that the prices are going to keep going up without the same interest rate engine pushing them. But the reason everyone wants to own real estate has nothing to do with the actual returns. Real estate is the easiest investment to understand. You can drive past it, you can touch the walls, you know what a house is. Compare that to buying a share of a business or an index fund. That's abstract. You can't see it. There's another psychological trap here, the I know somebody who got rich in real estate effect. You probably know someone exactly like that. Maybe it's a family member, a neighbor, a coworker. Their story sticks with you because real estate success is visible and concrete. You can see the house, you know the price they paid, but you don't hear about the landlord who lost $500,000 on a Florida house that they couldn't sell. That story doesn't get told at dinner parties. When you hear a real estate success story, ask one question the storyteller never mentions. What was the interest rate environment when they bought? 9 times out of 10, they bought during a period of falling or lower rates. The environment did half the work for them. Now, before we get into the winners, the losers, and my playbook for how normal people can build wealth, I want to hear from you. Every week, I'm interviewing normal people who found unique ways to build wealth on my podcast, Boring Money. If you want to talk about how you can compound to the next level, click on the link below and tell me a bit about your business. So, who is making money in real estate in 2026? I'll be honest with you, it's probably not who you think. Let me give you the honest answer. The people making money in real estate in 2026 are institutions, private equity firms, large funds, groups with hundreds of millions of dollars in capital. They bought up single-family homes after 2020 at scale. They own apartment complexes. They have access to debt that regular people can't get. They can accept lower returns because they're playing a volume game. And they've made it extremely hard for the average person to compete. Think about it this way. When a private equity firm bids on a house or a whole neighborhood of houses, they don't need it to cash flow well right now. They have patient capital. They can wait. They can absorb carrying cost. They're playing a different game than you are. Meanwhile, you're trying to make the numbers work on one house at 7% interest rates. You're not competing on the same field. You're not even in the same stadium. Here's where it gets really ugly. Let me show you the math on a real market. 10 years ago, a median home in Nashville was around $220,000. Let's say you put 20% down, or $44,000. Your mortgage at a 4% rate was roughly $840 a month. Rent in that neighborhood, maybe $1,400 a month. That's $560 a month in positive cash flow before expenses. Today, that same house is $450,000. If you put 20% down, that's $90,000. Your mortgage is 7%, roughly $2,400 a month. Rent in that same neighborhood today, maybe $2,200 a month. You're already underwater before you fixed a single broken appliance. Now, that's not a fringe case. That's most markets in America right now. Run this simple test on any property you're considering. Take your total monthly cost, your mortgage, your taxes, your insurance, any HOA fees, and compare it to what you could realistically rent it for. If those numbers are close or rent is lower, walk away. The margin isn't there to absorb the surprises that will definitely come. Even if the cash flow math works, there's a cost in real estate that almost nobody accounts for, and it will quietly destroy your returns. Rental real estate is a business. It's just a business that most people don't treat like one. And like any business, it has operating cost. The water heater breaks, the HVAC system goes out, and as someone who runs an air filter company, I can tell you, HVAC replacements aren't cheap. Every one of those events wipes out months of cash flow. I talk to a lot of landlords who will tell me that they're making $400 a month on a rental. And then I ask, have you had any major repair in the last 3 years? And then they say yes. And when I ask what it cost, it's almost always a year's worth of that $400. So the real return is nothing or close to it. And that's not even including the time that you're spending managing it. Now, add a property manager, because at some point you will want to take some time back. They take 8 to 10% of rent, sometimes more. On a $2,000 a month rental property, that's $200 off the top every month before a single bill gets paid. The cash flow evaporates. I'm not saying this to be harsh. I'm saying this because I see people make this mistake all the time, and the real cost only becomes clear 2 or 3 years in. You're a landlord, which means you're a maintenance coordinator. You're a small business owner with thin margins, difficult customers, and assets that depreciate while you sleep. When you're evaluating property, don't just model the cash flow, model your time. How many hours a month will this property take, including calls, repairs, showings, and stress? Then multiply those hours by what your time is worth. Add that back to your cost. Now, what does the return really look like? If you think commercial real estate is the smarter play, more professional, more stable, better tenants, you need to hear what's actually happening right now. Commercial real estate looked like the safest bet in the world until it didn't. 20 years ago, a Manhattan office building was considered one of the safest assets on earth. Institutional grade, irreplaceable location, blue chip tenants. Today, some of those buildings are basically empty. Remote work changed everything. Companies downsized their offices. Leases expired and didn't get renewed. And now you have these massive, expensive buildings that nobody wants. And the cost to convert them into something useful is often more than they're worth. Assets that looked permanent just stopped being valuable. This is the core risk in any real estate investment that most people never take seriously. The world changes in ways we can't imagine. Demand shifts, and real estate is extremely illiquid, which means by the time you see the problem, it's very hard or impossible to get out. The people who owned Manhattan office buildings a decade ago were not amateurs. They were sophisticated investors with access to the best information, the best lawyers, the best advisors, and they still got blindsided. If the smartest money in the room can lose on real estate, the idea that it's a safe place for your savings deserves a lot more scrutiny. If you're seriously considering commercial real estate, ask yourself this: what is the 10-year trend for this type of property? Is demand for this space growing or shrinking? Okay, this isn't all bad. There are actually much better, more flexible opportunities that are opening right now. At the end of this section, I'll show you 3 ways that I would strategically use some savings. People ask me all the time what I invest in. My answer is pretty boring, and it's working. Here's my actual portfolio, no fluff, no flexing. I'll be straight with you. Almost all my money is in FilterBuy. I am deeply concentrated in one business, and that's intentional. I know it better than anything else. I can control the outcome, and the return on capital is much higher than anything that I could get in real estate. That's the first principle. Put your money where you have the most knowledge and the most control. Building wealth comes from focusing on your unique advantages and skills. Preserving wealth comes from buying a bunch of assets. For the portion of my money that's outside the business, I keep it simple. Broad stock market ETFs, basically owning a tiny piece of thousands of American companies at once, and some Bitcoin. That's it. No rental properties, no commercial real estate, no complex structures. Now, does real estate ever make sense? Yes, absolutely. If you really understand a specific market and you can find a really good deal and you're willing to put in the work, it can absolutely work. I'm not saying real estate is evil. I'm just saying the default assumption that it's the safest path to wealth needs to be challenged hard right now. Here's something Ramit Sethi has talked about that I think is underrated. In many markets right now, it is cheaper to rent than to own. Not because renting is throwing money away, that's a myth, but because the true cost of ownership, when you include maintenance, taxes, insurance, and the opportunity cost of your down payment, is often 30 to 40% higher than renting. In those markets, the person renting and investing the difference is coming out ahead. This goes against everything we were taught. It goes against the gut feeling that owning is always better. But the math doesn't care about your gut feeling. Go look up the price to rent ratio in your city right now. You can ask an AI to calculate it easily today. If that number is above 20, renting and investing is almost always the better financial move. In many major cities right now, that number is 25, 30, or even higher. So, if you have cash to deploy and someone tells you to put it in a rental property, here's what I'd actually do instead. First, and this is the most important one, bet on yourself. If you're young, cash in the bank is not a down payment on a house. It's a runway to take real swings in your career or your business. My favorite move? Find a business owner who's thinking about retiring. Offer to work for them for free for a few months to learn how the business runs. Then, negotiate a deal where they finance the sale themselves. That's what's called an owner earnout. Basically, you grow their company, they get a passive cut of profits, and eventually the business is yours. Having money in the bank gives you the flexibility to take a risk like that. Most people can't even consider it because they don't have the cushion. That's the highest upside move that I know. Second, if you're not ready for that, save 15% of your income every year without fail. Put it in a low-cost index fund like the S&P 500 ETF, the total market ETF, something boring that tracks the whole market. Don't overthink it, just do it consistently. Third, invest in your skills. This is the thing that nobody wants to hear, but it's the most true. The skills that make you more valuable in the marketplace compound over time, just like money does. A 25-year-old who spends $10,000 improving their ability to sell, to manage people, or to understand AI will see a return on that investment that dwarfs almost any real estate. The boring truth is that your earning power is your biggest asset right now. Protect and grow that before you try to put money to work anywhere else. People want passive income, and I understand that. But here's the thing about passive income. It's a myth when you're starting out. Every passive investment requires active work to build first. The dividend stock portfolio requires years of saving and investing. The rental property requires capital, time, and management. The business requires building. There's no version where you skip the work and get the results. The question isn't, how do I make money without working? The question is, where should I put my work and my money so it compounds the fastest? And right now, for most people, the answer is not a rental property. If you want to see exactly how I think about building and buying businesses instead of real estate, watch this video next. I break down the whole playbook.